Well, good afternoon everyone, and thanks for joining us today for our webinar, Is a Self-Managed Super Fund Right for You? The Pros and Cons. It's great to see so many of you online with us today, and we're looking forward to a great session which should last about 40 minutes. Obviously, we'd love you to interact with us as well and ask questions throughout the session, and for those of you who are familiar with the GoToWebinar control panel, you will see that there is a ask a question or chat box at the bottom of the control panel. And if you would like to ask a question, I suggest you just use those boxes. So to begin with, could I just ask that anyone just types a message in the chat box just to confirm that you can hear us loud and clear? Are you all hearing us? Perfect, they're coming through great. Thanks so much for letting us know, that's cool. If you are a Twitter user, you can also interact with us live online using the hashtag #ManagingSuper. And if we don't get to all of your questions today in the session, we're more than happy to answer them offline as well, so don't worry if we don't answer your question immediately. Okay, we'll move on, and as with all of these sessions, I think it's important just to highlight that the information that you speak to an advisor who is going to talk to you specifically about your personal circumstances. So without further ado, I'm going to introduce you to your presenter today, who's Mr. Raymond Taggart, the Director of Taggart & Partners. Ray is a superannuation tax and business structuring expert with 25 years experience helping businesses to structure themselves effectively, minimise their tax obligations and grow profitably. So without further ado, I'll hand you over to Ray for a great session today.
Thank you very much for that introduction, Anne. It is wonderful to have you with us today on the webinar, and I can see from the attendees that we have quite a cross-section of people attending, and I note, just out of curiosity, that we've got John from WA. Thanks for being online, John. Joe from the Northern Territory, Ross from Sunnybank, Martin from Manly, just to name a few. So thank you very much for logging in and sharing your time with us today. Hopefully we'll be able to impart some wisdom along the way. So let's just get cracking. I guess if there's one key message from today, the one that I would like to impart is that I believe, and this is my opinion, that the window of opportunity to take full advantage of a self-managed super fund, if it is right for you, may be limited. To give a little bit of background on that statement, superannuation funds have been able to borrow money and invest in various products, most notably property, but that's not the only asset that a super fund can borrow to invest in. For quite some years now. I'm going back probably 7 odd years. What I've noticed is that most business owners that are seeking regular advice from their advisors, most of my business clients, were able to take advantage of the superannuation rules more regularly because they're in more regular contact with me, and I suspect that that is the case right around the country. What's transpired over the last couple of years is a feeling that the window of opportunity to use borrowing specifically within a self-managed superannuation fund may be coming to an end. And whilst that's not the case right now, there are some indications that that is the case. And I would hate for any client of mine specifically, or anybody else for that matter, for those that aren't clients of mine that are on the webinar today, that you missed the opportunity simply because you weren't aware that the gap may be closing. So that's the message that I'd like to get across today. So who is this webinar for? Effectively, anyone who doesn't have a self-managed superannuation fund currently but may be considering one, anyone who has a self-managed super fund but not quite sure if you're taking full advantage of it, i.e. the scenario I just mentioned. So all in all, anyone who wants to plan for their future. So what does that really cover? That covers self-employed people, business owners, retirees, but more importantly, employees. For mum and dads or that are in an employed capacity, you may have superannuation that is ticking away from you in what's called a master trust. That's the likes of Sun Super and AMP and those sort of superannuation players, and not really sure what you can do with it. So a superannuation in that form can be rolled into a self-managed super fund to take advantage of the flexibility that offers, which we'll cover today. So effectively, this webinar is for everybody either thinking of or currently having superannuation. So, and I think what I'd like to do before we sort of kick into the pros and cons is just maybe have a look at who is online today in terms of whether or not we've currently got people with self-managed super funds or not. So if we can please run that poll, that'd be great. So I'll just give everybody a couple of seconds to click on the relevant buttons. That'll give me an idea of who I'm talking to today. How are we going, Anne?
Okay, so it looks like we've got 15% saying yes, they do have a self-managed super fund, and 85% saying no.
Okay, so it looks like there might be quite a few online today that don't have a super fund that are obviously considering one. For that 15% that already have a self-managed superannuation fund, some of the items we cover may be old news to you, but reiterating something that you may have already known. So that at least gives me an idea of who we're talking to today, so we might just kick on, I think. What I hope you'll learn from today's webinar are obviously the pros and cons of a self-managed superannuation fund, the pros and cons of SMSF investing, and through those two aspects, maybe possibly gaining an insight as to whether or not a self-managed superannuation fund is right for you. As Anne mentioned in the introduction with the disclaimer, this is only general in nature, and I doubt whether or not you'll be able to conclusively make a determination whether SMSF is right for you, but this should go a long way towards giving you information that will enable you to make that decision. More specific advice may be required. What you'll receive today at the end of the session, what we'd like to do is give all attendees an ebook. You'll receive this after the presentation with the pros and cons, a more detailed version of the pros and cons of investing through a self-managed superannuation fund, and an opportunity for a free 30-minute one-on-one consultation. This will give those that are keen an opportunity to air their specific circumstances with me, and we'll have a more direct conversation regarding the pros and cons, or indeed whether or not it's right for your circumstances. Any questions so far, Anne? We haven't got too far through into the meaty business, but no, how are we looking?
Yeah, looking good. We haven't got any questions so far.
Awesome. A little bit about Taggart & Partners. We are a multi-award-winning boutique business advisory firm, and mentioned that at the beginning. So I just thought I'd throw in the awards that we've won in the accounting space, culminating in 2014 with the Accounting Business of the Year, which is one that we're very, very proud of. The thing that makes us different is, and this is a little slide I've put together, from my experience in dealing with other accountants in the industry, many accountants pay little attention to the fundamentals. They don't proactively give strategic business advice, or in this case superannuation advice, and most accountants think like accountants and not like business people, or just ordinary pay-as-you-go income tax earners, salary earners, I mean. What we try to do is start with the fundamentals, make sure that we get that right, we get it right from the get-go, and review it often. We love helping our clients save tax and grow their businesses, and indeed their investments for retirement purposes. And we act like business people with accounting expertise, which I think is sometimes a hard thing to do. We'll try to avoid the lengthy jargons and the section numbers and quotes from the tax office and those sorts of things, because that information might be relevant for other accountants and people within our industry, but not necessarily so for what I would call our average client. So we'll try to avoid those things. One of the words you will hear is master trust, and as I've mentioned previously, that relates to superannuation that is in the cloud. You don't effectively see it. It's managed by a big life office. They do all the hard work for you. So we'll use that term a little bit, but we'll try not to get bogged down with too much jargon. So that's what I think sets us apart. So as we go through the webinar today, we've broken it up into two sections, the pros and cons of a self-managed superannuation fund. So as you can see there, I've outlined the pros. You're in control. There's opportunity to hold your business premises, which I think is the big opportunity that the window might be closing on. The ability to manage or eliminate capital gains tax, and the opportunity to buy assets that you might not otherwise be able to purchase. On the con side, it's time consuming, preferable to have investment knowledge, high costs for small balances and penalties for non-compliance. So what we're going to do now is we're just going to go through in a little bit more detail those 4 items on the pros and the cons. So let's start with the pros of a self-managed super fund. The big one, and this really is the big one, is you're in control. When your money's in a superannuation fund that's a master trust, it effectively is controlled by somebody else on your behalf. Usually many members in the one fund being controlled on your behalf. So there's not a lot of involvement. But when you've got a self-managed superannuation fund, you gain control, and you determine with your advisor things like your asset allocation. That is, whether or not you want property or whether or not you want shares or managed funds or what type, those sorts of things. The tax strategies that may come with them, insurance options and retirement planning. Much more hands-on, much more flexibility and much more control. So that's one of the biggest benefits of a self-managed superannuation fund. The opportunity to hold your business premises. As I mentioned before, this is one of the biggest areas that may be limited in terms of scope. It can be tax effective. Self-managed superannuation funds provide asset protection for property. It also plays a big role in succession planning and the security of your tenancy. Now, for a self-managed super fund that holds the business premises, that is a very big issue, because the last thing that you'd want to do as a business owner is develop your business, develop your brand and your goodwill, and then have somebody tell you need to move on and find additional premises somewhere else because you're not in control of the situation. We'll go through business real property a little bit further in detail throughout the webinar, but that's just to give you a taste of what's to come. There we go. Okay. The ability to manage or eliminate your capital gains tax. Most of us would try and have a policy in place to minimise the taxes that might be applicable on sale of real estate or shares until a fund begins paying a pension. This is what we call pension mode. No CGT is payable once an asset is backing a pension payment. So there's 2 states to a self-managed superannuation fund, in fact all superannuation, and that is the before retirement and the after retirement. What we call before retirement is accumulation, and obviously after retirement is pension. Now this is what I call the holy grail in terms of super. It is the point where no tax is payable. The reason why it is the holy grail is because throughout our lives we'll pay tax as individuals, as companies, as business owners, as the case may be. Superannuation gives us a structure which we can limit our tax before retirement to 15%, which is probably the best tax position we can have for investment purposes in this country at this time. The only way we can pay less tax is not to have any income, and I'm sure none of us actually want to be in that position. So before retirement, investment earnings are taxed at 15%. Capital gains, provided an asset is held for more than 12 months, is only taxed at 10%. Dividends that carry an imputation credit, that's one of those jargon words, that's simply the tax that's already been paid by a company who's paying the dividend. That will be refunded to a self-managed superannuation fund, and the reason there is because companies pay tax at 30 cents in the dollar, but super funds in accumulation phase only pay tax at 15 cents in the dollar. So there is in fact a 15% difference in that scenario, which gets refunded back to the superannuation fund and hence can be added to the investment pool. So after retirement, in the pension phase, everything becomes tax-free. No earnings on investment earnings, no tax on investment earnings, tax-free interest receipts. Capital gains can be tax-free. Dividends are still, the imputation credits on dividends are still refunded, and pensions possibly tax-free as well. So this is what I call the holy grail, and this is why from a retirement point of view we want to try and get as much of our assets into superannuation at a low tax environment pre-retirement and at a zero tax environment post-retirement. Okay, so I'm just going to have a look at, did I skip any of these? No. Okay. Number 4, opportunity to hold, to buy assets that you may not be otherwise able to afford. Effectively what I'm getting at there is a self-managed superannuation fund is a vehicle that allows 4 people, can have more than 4, but it's typically best with 4, to pool their superannuation savings together to allow you to buy assets that you might not be otherwise. In this case I've chosen direct property as an example. And this is a question that I constantly get asked, more specifically not from business owners, but from salary and wage earning clients and the public at large, because we can put mum and dad together, say each has got $100,000, combine them into a self-managed superannuation fund, and we've got $200,000 with which we can do something with. Most people that I come across that are not getting the good oil, the advice that business owners get on a regular basis, tend to think that if their investment, if their superannuation balance is only $100,000 in a master trust, that they don't have enough to do with what they need to make a self-managed super fund and invest as they might see fit. They don't realise that you can combine the pooling of the savings together to create one super fund that can buy more assets that you might not be otherwise able to buy, or a better diversification of asset allocation. So that's a very big one, and I still think that the message may not be getting out there that that can be done. I'm quite astonished at the number of times I mention it, and it's then able to be taken advantage of. So that's what I want to make sure that nobody misses out on that. Okay. Any questions so far, Anne?
We've just got one question there from Ben, who wants to know, what does it cost to set up a self-managed super fund?
I knew that would come in sooner or later. Look, there's lots about that in the industry, about costs of setting one up and administering one. The rule of thumb is, and this does vary from advisor to advisor, but my rule of thumb is that it'll cost around $3,500 to establish a self-managed superannuation fund. That covers a whole range of things like trust deeds, the rules, corporate trustees, minutes, ATO registrations and the like. So there's a whole host of work that needs to be done around establishing a self-managed superannuation fund. On an ongoing basis, because this is the one that's probably more important for most people, what is it going to cost me year by year to administer it? For the tax and accounting side of the work that is required every year, that's about $2,500. Now that number does depend on the complexity of the fund and whether or not there is borrowing and direct property purchased by the self-managed super fund. There are some other costs as well. There's an Australian Securities Investments Commission cost for the corporate trustee. This is about $300 a year. There's also an external auditor that is required, and the cost of that's about $400 a year. So they're the costs then that are applicable, and I hope that satisfies Ben's curiosity. So we won't dwell on the costs. We'll move forward if that's okay. We'll just have a look now at some of the reasons. Everything's not rosy in the garden of self-managed superannuation funds, so it would be wrong of me if I didn't put forward the cons. One of the biggest ones is that it is time-consuming. Even with the services of a professional self-managed super fund advisor or an administration service, there's still some work required. With investments, there'll be multitudes of paperwork that are provided to you as a trustee of a fund, and you'll need to deal with that as you move throughout the financial year. Trust deeds will be drawn up as part of the establishment process, setting out the powers of trustees, how payments can be made, the exit strategies and those sorts of things. So it can be something that requires effort. If you're going to think about super in the same way as you would with master trust, all the hard work's already done by you by somebody else, so you don't have to do any of this work. I don't think it's onerous. There's not too much of it, but there is some work, and it is time consuming from time to time in terms of pulling together information to provide to the accountant for end of year tax and accounting purposes and things like that. So there is some time involvement. Excuse me. And as I mentioned there, if you look at the screen, we've got accurate paperwork that's required, operating statements, annual returns, auditors to be dealt with, and the queries that come through that process. It is also preferable to have some investment knowledge. Again, with a master trust, somebody else is taking your money, pooling it with a lot of other members and making these decisions based on their research into the market and your risk profiles that may have already been notified to the master trust. And that'll depend on your age bracket and where you are in terms of retirement and the like. So it is important to understand that as a trustee of or a member of a self-managed superannuation fund, you will need to have some understanding of what's happening within your fund, how funds are being invested, what costs are and taxation implications there are. I would encourage everybody to seek continuous advice, particularly for those that don't have a superannuation fund, the 85% online today that are thinking about setting one up. I suspect that you'd have more questions than the 15% that already do. And just simply manage risk in general. It's not enough to say, oh, my accountant set that fund up, therefore that person is going to take the responsibility for ensuring all my superannuation's all sorted and my investments are okay and I'm keeping the right records and all those sorts of things. So you need to have some degree of investment knowledge, and that's why self-managed super funds may not be for everybody. Now, I've noted this as a con, but there can be a high cost for small balances. It's important to understand, here's one of those jargon things, MERs, the management expense ratios. Master trusts generally charge your member balance somewhere between 1.5 and 2% based on what your balance is within the superannuation fund itself. Now, where you set up a self-managed superannuation fund, that can be very costly in terms of what the percentage is for smaller balances. As an example, if we had $100,000, and as I mentioned before, the average cost of attending to the year-end tax and accounting work is about $2,500, that's about 2.5%. Now that's obviously fairly expensive because it's a small balance. As you can see there, I've put up another example there of what a $200,000 balance would be at 1.5%, it's $3,000. And if you had $1 million balance in a master trust, 1.5% would be $15,000. So there can also be a significant saving. So as a con, this particularly is very important where there are low balances. From the research that we've done, we can see that the average member balance is about 540,000. So I would expect that it, as a management expense ratio would be fairly cost effective in that regard for those sorts of balances. So we call this the fund balance to cost ratio. So it's important to look at that when deciding on whether or not a self-managed super fund is right for you. The other big one, which is very relevant, is the fact that there are penalties for non-compliance. The self-managed superannuation fund the superannuation fund industry is governed by what's called the superannuation industry legislation, and it is very complex and has many rules and regulations, and that's why it's important to ask questions and seek advice hand in hand with your advisor as you progress through the superannuation journey. The biggest issue here is that if you get it wrong, and get it wrong big time, the market value of a non-complying fund's assets, less its concessional contributions, is taxed at the highest marginal rate. So that can be a very big dent in your retirement savings if you get this process wrong, get it audited by the ATO, and lose half your assets for not doing the right thing. I don't want to put too much emphasis on that, but it is the big stick that's waved by the ATO in order to ensure compliance. And as a general rule, I think it works pretty well. Knowing that at the start seems to make most members and trustees of self-managed super funds more accountable for how they conduct their superannuation affairs. There's some issues around whether or not the trustees are individuals or a corporate, and the ATO penalties that apply to that. The ATO made some changes a couple of years ago now, which gave them the ability to impose a penalty on individual trustees where a breach is evident, and that has a big implication where we've got a 4-member fund. For self-managed superannuation fund purposes, all members must be trustees. So if we're going to have individual trustees and we've got 4 members, we've got 4 people, 4 individuals that are acting as trustee. What happens there is that if there is a breach and the ATO imposes a penalty, each one of those individuals will be charged with the relevant penalty, which can be very onerous. If we've got a corporate trustee in place, then only one penalty would be levied in such a case. And since that legislative change a couple of years ago, we have made sure that none of our clients with self-managed superannuation funds have individual trustees. Any administrative penalty imposed on a trustee cannot be reimbursed or paid from the fund. You must pay the penalty out of your own pocket, so that's another big issue. The ATO has no discretion to reduce or withhold the penalties, meaning even inadvertent and accidental breaches will attract a penalty. Just to give you an idea of what those penalties are, I'll just mention a couple. So failure to keep records for 10 years could be a $1,700 penalty. Information not given to the regulator when asked is an $850 penalty. A breach of an in-house asset rule could be $10,200. And similarly, loans to members from the self-managed superannuation fund, also a breach, could attract a $10,200 penalty. So it's very important to make sure that self-managed super funds are administered correctly. So I think we might just break there for a minute, and let's have a look at the age bracket of today's webinar attendees. So we'll put up another poll there, and if I can ask everybody just to take a moment to click on the relevant box and just give us an idea of who we're dealing with. So we know that 15% have a self-managed super fund today and 85% don't. Let's have a look at whereabouts in the retirement journey or the accumulation journey our attendees are today.
Okay, so it looks like we've got 12% in the 30 to 40 age group, 56% in the 40 to 50 age group, and 32% in the 50 to 60 age group.
That's very interesting, eh? Probably not surprising, but it is somewhat interesting. Obviously we don't have too many younger generational people on the webinar today. I will make a little side comment there that it would seem that there is a growing trend for younger people to set up their own self-managed superannuation funds, and I suspect it revolves around the control and the flexibility aspect. We are seeing that more people within that 20 to 30 bracket and that 30 to 40 bracket setting up self-managed superannuation funds so that they can control their own destiny. And I think some of that is, particularly in the 30 to 40 bracket, is that SGC Super, the superannuation guarantee that's paid, the 9.5% that's paid on wages paid to employees, has been around for quite some time now and starting to accumulate. And more specifically in that 30 to 40 bracket, where couples get together and marry, then they realise that they can pool their superannuation money together and create a larger balance. And with a larger balance in a self-managed fund, enables them more control over their investments and their retirement. So younger people are indeed looking further ahead, probably more so than what has been the case in the past. So just a little note on that. Okay, so let's have a look at the gearing aspect of investing with a self-managed superannuation fund, and how does it work. In effect, I'll go through the slide in a minute, but in effect what happens is, firstly, we'd establish a self-managed superannuation fund if it was right to do so for your circumstances. Organise rollovers from those master trusts that we spoke about into your self-managed superannuation fund. Redirect any future contributions from employers away from the master trust and into your self-managed superannuation fund. Then we would use the self-managed super funds money that's been rolled over as a deposit for an investment. Borrow the balance either internally or externally, and I'll explain that in a minute. And then the rent / lease back to the business or future contributions would go towards repayment of the loan. So if we just have a quick look at the diagram, you can see there I've made reference to the trust in the middle. That is a special trust that needs to be created, not in the ordinary sense that most people would understand, which is a requirement of the legislation that governs borrowing with self-managed super funds. So a special trust is created to legally acquire an asset. The superannuation fund provides the deposit for the purchase. A lender will provide the loan to the super fund, the self-managed super fund. Now that lender can either be internal or external. When I say internal, for a business owner, that may be you providing funds to your self-managed superannuation fund on the same terms as a bank would do, but doing it internally because you've got the assets to do so. Or it can be externally funded through bank finance. The loan would then be provided to the super fund, and the super fund would then use all the money to acquire the asset. And there is what's called a limited recourse against the asset. So one of the special function or features of being able to borrow with superannuation is that a bank can only take recourse for the loan that is provided against the asset that it's providing the loan for. So in this case, we've got a house or a factory or whatever it is that you'd like to call that purple roofed building. The bank can only take that asset in a worst case scenario for repayment of its loan. So there is no recourse against the self-managed super fund's other assets, or indeed the members and the members' personal assets that are within the self-managed super fund. So there's a big incentive there in order to undertake that sort of arrangement where there is no downside other than the loss of the investment and the initial deposit that's being made, because the bank can only take the asset as a limited recourse. And then of course we've got the tenant and or the business owner, depending on the circumstance, paying rent back to the self-managed super fund. So I'll just go through those again. The ability to unlock equity in your business premises. this relates not so much to the employees that are online today, but for business owners, where you actually have currently existing business premises that you're renting to yourself, to your business. You can actually transfer that into superannuation, transfer the cash out of superannuation, and we've basically done a reversal. So the asset's gone in and the cash has come out. You can then take the cash and use it for other purposes, either more investing or debt reduction or fund business acquisitions or the like. The ability to pool savings by fund members to buy larger property, we mentioned that earlier. The lender only has recourse over the property. We've mentioned that as well. Diversification of your super fund investments. By being able to take some of your super fund money and gear it and buy an asset such as property, as we mentioned earlier, that may still allow you to have some funds available for diversifying into other asset classes, shares, managed funds, those sorts of things. And future contributions that you might make, if depending on the level of contributions that are made, if they're not put towards repayment of the loan, they can be put towards diversifying into other assets. Very, very tax effective, obviously, the structure in pre-retirement mode in the accumulation phase is only taxed at 15%. Any gain taxed at 10% in accumulation, and obviously tax-free in pension mode, which we've mentioned earlier. The downside of investing with a geared investment inside self-managed super fund, costs can be quite high. And that's the same within, and I'm going to use property as an example here, but that's the same with any property investment, whether it's inside super or outside super. In a lot of cases, we would see investments being made and not giving due consideration to the other costs involved. So no different here, but the costs are still relevant to be discussed as a downside, if you like. In terms of the upfront costs to set up the special trusts and the structures required by the superannuation legislation to allow us to borrow in a legal way, the actual legal expenses, the advice that's required in order to be able to proceed down this path. Stamp duty is a big one, bank fees, property management fees and the like. So all those costs need to be weighed up in terms of an investment strategy and the decision as to whether or not A, the self-managed super fund is right, or B, whether or not the investments that you might wish to undertake would be relevant for your circumstances. So the cash flow must be sufficient to meet the loan repayments, the property expenses, the pension payments, your tax obligations, and so on and so forth as well. And as I've sort of already alluded to previously, the regulatory requirements are quite complex. We still need to meet the sole purpose test, which is retirement. Assets such as property cannot be acquired from a related party unless it is the business premises or listed securities, and the property cannot be lived in by members or relatives of members. So there are some restrictions there as well. And because there's so many restrictions, it is necessary to be very, very close with your advisor in respect of what you want to achieve and what actions are taken on a yearly basis with your self-managed super fund. So there we have it, guys. That's pretty much the long and the short of the pros and the cons of a self-managed super fund. Let me just think. I mentioned this right at the start, that the window of opportunity may be getting less. Just to reiterate that, back in about May this year, some of the major banks actually withdrew their policy for providing loan facilities for some self-managed super fund property-related investments. Now, there is still many providers, many banking institutions that will provide funding in this space. They do have policies and products in place, but there is a tightening up of banks generally in terms of lending to buy property within self-managed super. What we've seen is that tightening has been more specifically related to purchasing of investment rental properties. not so much for commercial business premises. So, but there are still that'll do both. So when I say that it's the opportunity may be getting limited, just recently we had the Murray inquiry into the financial sector, and there was a recommendation that self-managed super fund loans be banned altogether, but that was rejected. So as I say, banks earlier in the year changing their lending policies. Some of them have actually increased their loan-to-value ratios, their LVRs. So instead of only requiring a 20% deposit, they now require a 30% deposit. So there's have that sort of action. And we've also had the inquiry recently that looked at it as well. So the upshot of the Morrow inquiry was that that was rejected. It's still okay to do, but my question is, for how long? So if we procrastinate, we might get to a situation down the track where it is taken away altogether. And those that are in and take advantage of the flexibility and what you can and cannot do will be okay, and those that aren't will simply miss out. And as I said right at the start, I don't want any of my clients specifically to say I would have done that if I'd have known. So my goal is to make sure that everybody I talk to in relation to superannuation is aware that there is an ability to do certain things with self-managed superannuation fund, and that specifically in relation to buying property and investing in a geared way. So don't procrastinate. Talk to an advisor today is my tip. Self-managed super funds are not for everybody. There are complex rules and it does require regular involvement, but it can be a very rewarding journey to take in terms of looking after and being in control of your own destiny. So the next steps, if you are considering starting a self-managed superannuation fund, or you already have one but not too sure still whether or not you're taking full advantage of the system, then what I'd like to do is make your next step easy for you. As our special offer today, we're going to provide a complimentary 30-minute personal consultation to review your super and answer your more specific questions. So that way we can dig down and get into those specific circumstances and maybe help give you a little bit more insight as to whether or not it's right or whether you're taking full advantage. The catch for the consultation, obviously, limited to the first 10, so best in, best dressed. At the end of the webinar, we'll provide a link which you will be able to register for and take advantage of that free consultation. So ask yourself the question, what will you do now? Will you procrastinate or take some action? I'll hand over to Anne, I think, at this point.
So thanks so much for attending. As promised, the e-book, The Pros and Cons of Investing Through a Self-Managed Super Fund. There'll be a link sent out to you within about an hour at the end of the webinar, and the link to register for a free 30-minute consultation will also come as part of that email. As Ray said, it's limited to the first 10, so get in there quick. And also, if you weren't able to join us for the whole session, we're recording the session as well, and we'll make the recording available to you. So again, I'll make sure that the link to the recording is sent out to everybody who's joined us for even part of the session. So on that note, I'd like to thank everybody for coming along to the webinar today. We look forward to seeing you at our next one soon. Thanks so much, everybody.
Thanks, Sam.